When a contract is on the line, but your working capital is completely tied up in accounts receivable, speed is no longer a luxury. It is a strict necessity. Most business owners in this situation look for fast business funding, same-day approvals, or 24-hour cash injections. But there is a silent killer in the commercial underwriting world that instantly grinds fast applications to a screeching halt. It isn't a low credit score, and it isn't a lack of monthly revenue. It is a mismatched, messy, or completely missing business debt schedule. Underwriters move at lightning speed when your financial data is presented with absolute standardization. The moment they have to chase down missing loan balances, unknown maturity dates, or hidden daily merchant cash advance splits, your file gets flagged and pushed to the bottom of the pile. Today, we are breaking down the exact step-by-step framework to build a bulletproof business debt schedule that alternative lenders trust. How to turn your liabilities into an asset that unlocks lower interest rates, and the critical data matching rules you must follow to guarantee rapid funding decisions. To understand why a debt schedule is always the very first document an underwriter asks for, you have to look at your business through the lens of a commercial lender. When you are generating $10,000 or more in consistent monthly deposits, lenders already expect you to have some form of outstanding liabilities. Using outside capital to scale operations is a clear sign of business maturity. The real question an underwriter is trying to answer is not whether you owe money, but whether you manage that debt intentionally and whether your current cash flow can safely support a new line of credit. A business debt schedule provides a single, unified snapshot of your company's entire debt landscape. It bridges the gap between your balance sheet and your bank statements. It details your term loans, equipment notes, corporate credit cards, open vendor lines, tax payment plans, and revenue-based financing balances. When you submit a clean schedule of liabilities, you are demonstrating to a lender that you understand your debt service capacity. It allows them to quickly look at your debt structure to determine if your new request is a healthy bridge for growth or a desperate attempt to patch over a deeper structural issue. For example, a contractor waiting on a major milestone draw might just need a short-term working capital bridge to cover payroll, whereas an e-commerce brand needs inventory financing to scale into a seasonal rush. A transparent debt schedule tells that exact strategic story instantly, which is why a well-organized file frequently opens up premium options with significantly better pricing and zero upfront fees. Building a document that commands this level of authority doesn't require complex accounting software. It requires a simple spreadsheet, 1 hour of uninterrupted time, and an absolute commitment to data integrity. Your debt schedule must live on a single sheet, with every single liability organized in rows and tied mathematically to one specific as-of date. Every professional debt schedule must contain 7 core columns. First is the debt type, which explicitly classifies the capital tool, whether it's a fixed-term loan, a revolving line of credit, or a revenue-based advance. Second is the creditor name, identifying the specific commercial lender or private capital provider holding the note. Third is the original loan principal, showing the baseline size of the initial facility. Fourth is the current balance, which must reflect the exact amount currently drawn or owed as of today. Fifth is the interest rate, or the clear factor rate structure governing the cost of that capital. Sixth is the exact monthly or daily payment amount. And seventh is the maturity date, establishing the definitive timeline for when that obligation ends. But the absolute secret weapon on this sheet is the 8th column, the notes column. This is where the majority of small business owners miss a massive opportunity to control the narrative. Use the notes section to provide immediate context for every balance. If a revolving line is currently drawn down, state clearly that it was used to buy discounted inventory at a 30% margin. If a short-term advance is on the books, note that it was an emergency facility used to replace a critical piece of broken equipment that has already been resolved. If a specific balance is scheduled to be completely paid off and consolidated by the new loan you are applying for, flag that right here. This proactive context eliminates underwriter confusion before it even starts, dramatically accelerating your path to approval. To construct this file properly, follow a strict 4-step workflow. Step 1 is to pull every single current statement. Gather your commercial loan agreements, equipment lease summaries, tax schedules, trade supplier terms, and business card statements. Use the exact month-end figures or real-time today's balances, ensuring that every document matches the exact same baseline date. Step 2 is to group your debt by type and purpose. Separate your long-term fixed asset financing from your short-term cash flow tools. Do not mix your permanent equipment notes with your revolving working capital lines. This helps you see if your current capital structure is balanced, or if you are accidentally stacking short-term daily payments on top of each other, which creates a highly toxic cash flow squeeze. Step 3 is to reconcile your data directly against your real cash flow. Total your entire monthly debt service and weigh it directly against your average monthly deposits and gross margins. This is exactly how an underwriter calculates your debt service coverage ratio. If your debt schedule, your balance sheet, and your recent bank statements do not match down to the exact penny, it triggers an immediate red flag for fraud or sloppy bookkeeping, which will instantly kill a 24-hour approval window. Step 4 is to highlight your strengths. If your business has a solid credit profile, strong recurring revenue, or at least $15,000 in consistent monthly deposits, call that out clearly at the top of your file to position yourself for premium, low-cost capital options. When you present a hyper-professional, reconciled debt schedule, you completely flip the power dynamic in the lending process. Instead of appearing as a reactive borrower looking for emergency cash, you present yourself as a sophisticated, disciplined operator using OPM, other people's money, to strategically scale an enterprise. This transparency directly translates into better payment terms, lower annual percentage rates, and larger lines of credit. Underwriters don't have to price in the risk of the unknown because you have laid every single financial card on the table. A clean file allows them to quickly identify debt consolidation or refinancing opportunities that can instantly slash your cost of capital and free up trapped cash flow. If you are ready to stop guessing what lenders want to see, get a clear grasp on your true debt service coverage, and structure your business financials to guarantee maximum fundability, click the link in the description below to review our alternative funding options. And let's secure the strategic leverage your business needs to scale with absolute confidence.